Hi guys, welcome to Boom Trading. This is the short series video for the current week. I'm Tintin Trading and today I'm going to talk to you about evaluating a trading system. Now, the SQN method is the best way that we suggest to use in order to evaluate the trading system. SQN stands for System Quality Number and was invented by the recently late Dr. Van Tarp, also one of the first stock market wizards covered in Jack Schreiber's book. Now, instead of starting with the agenda, this time we're going to start off with a story. Now, I want you to imagine that you suddenly wake up and you are sitting on a lottery ticket in the back of your pocket that just turned out to be a recent winner. Now, it turns out there are two stringent rules into you getting your money. Number one is that you will only receive your money if you invest it in the stock market. And side note, where else would you put it anyways? But number two, you would have to choose from one of the six custom traders to manage your newly won fortune. And you give in this prospectus and ask to choose the system that you would like to be managing your money. Now, you were giving the prospectus looks like that. We have system 1, 2, and 3. The system have their win rates. So 20% win rate, 50%, and 90% win rate. 90% win rate means that out of 10 trades, 9 will be winners and 1 will be a loser. You have the number of trades that are generated per month. And then you have the whole universe of trades that you might experience with this trading system. So for instance, 7 minus 1R, this is the actual result. And if you don't know what R's are, I would suggest for you to stop the video and go over into previous week's video and understand what are R multiples. But if you do, just for those of you who have a vague idea, R stands for a single unit of risk. And we can safely assume within this video that for a 100K portfolio, 1R stands for $1,000 or 1% of the equity, just as an assumption. So system one generates 7 minus 1Rs or 7 losses, which are going to be at absolute value of $1,000, 5 minus 5R loss, and 10R winners. The way you would read this for the 22 trades is that imagine you have a bag full of these marbles, and on them are written the results. Every time you pick a marble from the bag, it tells you what you've picked. So you might pick the 10R winner, then you return it back in the bag and you pick the next one. And that's how you would have 22 trades. It's like a never-ending universe of stocks. And this is the first side of the prospectus, and this is the second side of the prospectus. You would see here quite different trading systems, with system number 5 having only 10% win rate. Now, what I want you to do is on the next slide to stop the video and to write down which system number you would prefer and why. The way I want you to rate them is to rate number 1 as the most preferable and number 6 as the least preferable. In order for this to be easier, you can stop the video right here. And here are all the 6 trading systems. Now, this is very important because hopefully we will use what you write now in order to create this paradigm shift into your understanding of evaluating trading systems. So method number 1, and we expect that the average person uses this the most, is to evaluate based on a win rate. So system number 3 has 90% win rate and it's likely to be put on top. This means that people would look at systems which generate a lot of winners and would put that as the most preferable trading systems. Did you rank your systems by win rate? If you do, you might want to watch the R multiples video, because if you did watch the R multiples video, you wouldn't have used that, as you would know that this is not the best way to evaluate systems. Now, method number is to use expectancy. Now, I want you to just give you the legend for the color coding. When you see a system number with yellow color, this means that it's been changed since the previous method. So as you see, all the system numbers are shuffled in terms of what's good and what's not. And when we look at expectancy, we would see that system number 5, which was previously the worst system right here, is actually the one that ranks on top with expectancy of 4.10. Now, if two systems are close in terms of expectancy, it's normal to go for the one with the higher win rate. And expectancy, you would see, is inversely correlated to the win rate. Notice that the 90% win rate system actually has negative expectancy. If you don't know how to calculate expectancy, again, I'll point you out to the video from the previous week called R multiples in the short series playlist. From then on, method number 3 is something that Dr. Van Tarp has described as expectunity. Expectunity is basically taking the expectancy, timesing it by the number of trades per month, because as you see, some trading systems generate very few signals, whereas some generate quite a lot of signals. So that needs to be taken into consideration as well, and henceforth, method number 3 is expectunity. You would see that system number 5 generates about 61.4 expectunity number, whereas system number 3 generates -6 expectunity number. This is not the best method, so don't worry, it's much better than the previous two, but again, this is not the optimal method. Now, from then on, we need to start thinking about drawdowns, and this is where method number 4 comes in. Notice what happens. The system with the worst positive expectancy becomes the best system in terms of avoiding drawdowns so far. If you don't know what a drawdown is, basically think of it as if this is your equity curve from your trading, we look at what's the maximum that you are likely to experience in terms of equity at any given point of your equity curve. So a drawdown is basically how much you can lose. On average, we would see that runs of minus 8.7 R as an average drawdown. And if R is $1,000, we would expect that if we start losing money, an average lose rate would be about $8,700. But we'll see that the maximum drawdown is 34R, which is quite a lot. Also, we'll see that for system number 3, which was the one with 90% win rate, the actual maximum drawdown that can occur is 184R, which if R is 1% is 184% loss. So this would mean that you would blow up the account with this system. The way we calculate these numbers, the maximum and the average drawdowns, is to use simulations of large sample of 100 trades. Now you might ask how many, and the answer is 10,000. So we grab a system, we run 10,000 times to see every possible 100 trade scenario in terms of expectancy and average result. You have to use a special software, and we have alternatively gathered a method in order to estimate very closely the maximum and the average drawdowns without running 100Ks. Now, if you don't have the software, do not worry, this is still not the best method to evaluate your trading system, but it is something that you want to take into consideration. And now we're moving on to the SQN formula, which is actually what we advise as the best method to evaluate your trading system. Now, the SQN formula stands for the system quality number. Again, it's created by Dr. Van Tarp and takes the expectancy R that you calculate here, divided by the standard deviation times the square root number of the number of trades. So that's the formula for SQN. And you would see that if we use that, it's applying statistics to these trading systems in order to determine which one is best in order for our objectives. So the problem with all the first three methods is that they did not take into effect the variability of the system and the potential for a large drawdown. As I said, Dr. Van Tarp is the inventor of this method, and he does a pretty good job on determining if a system is good, which is our task here. Now, essentially, the SQN method is a statistical T-score for those that are statistically inclined. You would understand this quite well. Notice what happens. So system 2, which had the worst positive expectancy and the smallest standard deviation, now is valued on the first place. It suddenly looks really good since it has this very low variability and has a lot of trades. We already saw this when we looked at the lowest variability. System number 6, which was high in all the other methods, now becomes the one with the lowest rating. So if you follow our methods, you will never trade system number 6. As you see, nothing can save system 3 with a negative expectancy. So by the most accurate measure, system number 2 and system number 5 are the two best methods. Did you rank them like this? Go back and see what you wrote on the little piece of paper. Did you rank system 2 or 5? If you used anything else, I'd love to hear that in the comment section below, so just tell us. Another way that you can use, and this is method 5.1, is if we use method 5.2. And here, what we're doing is essentially getting the numbers of the trades, and we're equating them one to the other. We use equal number of trades generated per month. You would see that if we do that, system number 5 actually becomes the best trading system out there. This is because we eliminate this square root and variable. Both of these methods are viable and have merit in using them, and further on in the video, I'll tell you how and why you would choose one over the other. So, did you rank your systems this way? If yes, why? Hopefully this video and these ideas here are making some paradigm shift into your thinking about trading systems. Now, here is an overview of all the different methods. And as you see, if you use the win rate, system number 3 would have been your big, and system number 5 would have been the one you differ from. Whereas if we use the SQN 100 method, system number 5 from here will come here. Now I've highlighted all the twos to see that based on the method that we recommend, system number 2 actually comes up quite far. But if you use expectancy or expectunity, it's actually considered one of the two worst methods of trading. Now, as I said, these are superior methods, so this is what you should stick to. And I'm only saying this that if you use any of these ways to evaluate traders, to evaluate trading methodologies or communities or your trading system, then they might not give you the best and most accurate picture in terms of what is best for your objectives. If we look at the SQN scores, Dr. Van Tarp has given some general guidelines what is a good and what is a bad trading system. And you would see that if you have a score less than 1, it's a very hard to trade system. So these are trading systems that we don't want to take. Generally, he refers to system SQNs of 2 and above to be those that are significantly different to 0 and are tradable. Anything below that is quite difficult to trade. Notice that none of our sample systems are actually really good. Just 2 of them are high enough to be considered an average system. So we look at these numbers and we're looking that only those 2 are actually considered to be high enough to be considered an average system. Here, you probably need to be very careful when you're trading highly ranked systems. This is because chances are that you have not yet seen your worst case scenario, although that probability applies to every single system. The difference here is that in these theoretical examples, we have the full universe of trading scenarios, whereas in a real life trading system, this is not the case. We would only have what we have experienced, and unless we have experienced something over long periods of time in various markets, we would only have a fraction of what might be applicable for us. However, for a highly ranked system, a significant loss, if the 5 archaeological rows, could be significantly damaging to your equity. Why? Because if you have a highly ranked systems, you are likely going to overestimate your position sizing and you're going to bet bigger than you should. Henceforth, this might be very damaging to your equity and your psychology as well. So don't just take these guidelines and apply them to systems. Make sure you have an adequate position sizing strategy on top of that. If you only have a sample of 10 trades, we'd advise you that you use an SQN number of at least 3.5 in order to begin thinking that this is a good system. If you have a sample of 20 trades, then you would need a system quality number of over 3 to begin it's a good system. And with 30 trades, you would drop that number to about 2.5 to begin thinking it's a good system. However, with such small samples, and even 30 is a small sample, you only have the beginning of what you might expect from a trading system. Now, using SQN, of course, has its limitations, and this video would not be complete unless we go over them. And suppose you are testing data from over for the last 20 years for some trading idea. And the results are here. This is system number X. The results are back testing and they look spectacular because they give you the SQN of over 5. Now, if we refer back to our table, an SQN of over 5 basically means superb system. As you see, very few exist. Now, is this really true? No, it isn't. It really points out the basic problem with SQNs, and that is that when you have too many trades, you can strongly overestimate the system quality number. So if you have fewer than 100 trades, the number of trades should be the trades that your system generates in 1 year. However, if you have over 100 trades in a given year, then we advise that you simply use the SQN 100 in order to calculate the SQN. So basically what I'm saying is that If you have less than 100 trades per year based on your trading system, use this method 5-1. If you have over 100 trades in a given year, then I suggest you use a standardized uh, square root n of 10. So that basically means 100 trades. So you equate one over the other based on how active is your trading system. Now, point number two is that is the R multiple that we use a valid distribution, i.e., does it really reflect what is likely to happen? And we can stem out two questions which are important to understand the SQN limitations. Now, first, is the system statistically probable, i.e., if you have positive expectancy, and here it's 0.39R, the SQN method says whether or not it is statistically significant, i.e., with above 95% confidence level, to reject negative or zero return. So, if this is the case, then you need to point out to the second point. How likely is that the sample that we use to calculate the SQN score represent the true population, or at least the true population that we like to experience in the given market environment? Now, a minimum sample size that we recommend is 30, but 100 trades are much better, and this is for a swing trading system. So even if you have 100 trades, are they adequate for the current market that you're trading? And the way that we dissect and score the market is using this type of matrix. So we look at the price action and we look at the volatility. That ranges from super bullish to super bearish and from volatile to quiet environment. Now, what you want to do, and this is pretty much an essence that 95% of the traders do not get, you want to understand where is the easy dollar environment for your trading system and to trade your maximum when you're in that kind of environment. I know for the trading system that I use that I'm waiting for super bullish, neutral, and quiet environment. So this is my quadrant here. When I'm here, I'm maxing out the risk. If I'm here, I'm either 100% in cash or I'm very nimble. If I'm here, I'm moderately aggressive. And that's what you need to use in order to determine your position sizing strategy. Now, while you might not trade your system in all six kind of market, you need a large sample of trades, ideally more than 100, but at least 30 for each of these six markets in order to get adequate idea of how your system would perform in the different markets. Now, another point, if someone tells you that they can offer you or teach a trading system that works in all different market environments and all different volatilities, i.e. applicable for all of these, they're lying to you. No such trading system exists. And you have to be very cautious of this kind of advice. Either the person doesn't realize, doesn't understand this kind of analysis, or is trying to actively manipulate you. So if you don't meet the criteria of your easy dollar environment, then you ought to be very risk averse. But even if you do not have all the data for every single cell here, then you really do not know what to expect from your trading system. So that's very important for you to understand. This is again some sort of a limitation to the SQN method. Now, the last assumption you need to take a look at is how many simultaneous trades your system could really make. What I mean is that when you calculate SQNs and most ways to evaluate trading systems, you assume consequential trading. I open a trade, I close it, then I open the next one, so on, so on. Those systems do not look at simultaneous tradings. Now, there are different ways that we can evaluate simultaneous trading as well, but the SQN score does not do that. Henceforth, currently I have 9 open positions in the market. What happens if we get a black swan event, an October 87 crash, a black Monday, or so on or so on, where the S&P went down 20% in a single day? What happens then? Of course, this will be quite detrimental to your equity, but also it would reflect what we're saying here, the SQN number, and it will be one of those cases where you would experience something that you likely haven't experienced before. Simultaneous trades are not covered in the calculation, so you need to take that into consideration when you choose your position sizing guidance. So hopefully this was informative. I'd love to hear your ideas into the comment section below. If you have any question, you can find me on Discord, and good luck with your trading.